Silver market is not normal price action. Silver didn't just grind higher today. It exploded to 106.55 in off-hours trading, a violent gap up that tells you something far bigger is happening beneath the surface. This wasn't a slow trend continuation. This was a market shock that occurred outside regular trading hours, and it's the kind of move that only happens when real money and real urgency show up, not casual retail interest. Now, before we dive into the why, hear this. I'm not here to sell you anything. I don't run paid signals. I don't manage funds. Protect your capital. Think logically, not emotionally. So let's unpack this. Why this move matters. Silver's price is supposed to reflect fundamentals: supply, demand, industrial use, investor interest, and macroeconomic stress. But when silver gaps up violently, especially in thin electronic trading, it's telling you that big players are stepping in with size when liquidity is weakest. That means someone believes the current price significantly undervalues the metal, and they're willing to pay up to secure exposure immediately, and it's not happening in a vacuum. The Venezuela factor. Over the past few weeks, geopolitical risk tied to Venezuela has become a major driver for safe haven assets like gold and silver. Escalating U.S.-Venezuela tensions, including the reported capture of Venezuelan President Nicolas Maduro, have pushed investors into precious metals as hedges against instability. Silver prices rose sharply alongside gold in this environment of heightened geopolitical uncertainty. Silver isn't just reacting to economics, it's reacting to fear and risk. How Venezuela's situation affects the U.S. economy. Here's the link most people are missing. Safe haven demand. Capital flows out of risk assets. When geopolitical tensions flare, investors shift toward assets perceived as stores of value, gold and silver, and away from stocks, bonds, and dollar-denominated risk. That can weigh on broader U.S. financial markets. Commodity price shock can ripple through inflation. When silver, a strategic industrial and monetary metal, spikes violently, it signals market stress. A surge like 106.55 pars is not based on new industrial demand alone. It's tied to risk premiums rising in global markets. Rising commodity prices often feed into inflation expectations and can force central banks to rethink policy. Venezuela's resource paradox. Although Venezuela is best known for oil, its broader resource dynamics, continued geopolitical instability, sanctions, and export disruption contribute to uncertainty across commodity supply chains. Markets hate uncertainty. It pushes prices up and volatility higher. Safe haven flows can strengthen precious metals at the expense of the US dollar. As traders globally price in political risk, they allocate capital away from fiat currencies and into tangible assets. Silver's explosive gap move is symptomatic of that shift. Supply, demand, and macro stress indicators. Silver has already been trading strong this year, buoyed by a combination of supply constraints and investor positioning, and geopolitical risk added fuel to that rally. Experts have noted silver pushing higher whenever tensions flare, but this 106.55 move is different. It happened off hours, where liquidity is thin. It was sharp and violent, not slow accumulation. It reflects urgent demand overwhelming available supply at current prices. That's not typical market behavior, especially for a metal whose industrial uses are well known, but rarely trigger such explosive sudden moves on their own. This is more than a price spike. It's a risk signal. When prices gap violently, especially in a strategic commodity like silver, it telegraphs a broader fear premium in financial markets, not just in commodities. Consumers and businesses should pay attention because financial markets may see wider swings as risk appetite fluctuates. Inflation expectations could get repriced. Central banks might adjust policy if safe haven assets continue to drive volatility. The unresolved questions. We don't yet know whether the 106.55 level will hold once the regular session opens, whether this is a one-time geopolitical shock or the beginning of a broader repricing, how institutional holders and physical market participants will respond. But what we do know is this: prices don't gap like this in normal markets. They gap when uncertainty, risk appetite shifts, and systemic stress collide. And today's move isn't just about silver, it's about how geopolitical risk is now feeding directly into market pricing mechanisms. So check the data yourself. Watch the geopolitical headlines. Track how markets react tomorrow. Make your decisions based on evidence, not emotion, because this is your capital, your future, and your responsibility. Invest with logic, not fear. The 106.55 silver spike was a stress signal, not normal volatility. Silver didn't rise gradually. It gapped violently in off-hours trading, which only happens when urgent institutional demand overwhelms thin liquidity. This kind of move signals structural pressure in the market, not retail speculation. Venezuela-driven geopolitical risk is fueling safe haven flows. Escalating instability tied to Venezuela has increased global risk perception, pushing capital into hard assets like silver. This isn't about industrial demand alone, it's about fear premiums and capital flight away from uncertainty. Silver's explosion reflects broader U.S. economic vulnerability. When silver spikes violently, it often precedes inflation repricing, market volatility, and stress in the U.S. financial system. Safe haven demand rising means confidence in fiat systems is being questioned, even if quietly. This move exposes a fragile pricing mechanism. A sudden off-hours surge shows that paper markets can reprice instantly when real risk enters the system. Whether the spike holds or retraces, it reveals that market stability is thinner than most investors realize. The 106.55 silver spike was a stress signal, not normal volatility. When I opened by saying this is not normal price action, that wasn't rhetorical drama. It was a statement of market fact. Markets move every day. Prices go up, prices go down. That's normal. What is not normal is a strategic metal like silver gapping violently to 106.55 in off-hours trading when liquidity is thin, participation is low, and most retail traders are asleep. That kind of move doesn't come from enthusiasm. It comes from urgency. To understand why this matters, you have to understand where and when it happened. This move occurred outside regular U.S. trading hours, on electronic markets where price discovery is far less forgiving. During these hours, the usual shock absorbers of the market are largely absent. Market makers step back, liquidity providers reduce size, spreads widen, the system becomes fragile. In that environment, prices are supposed to move less, not more. So when silver doesn't just tick higher but jumps dollars in minutes, it tells you something critical. Someone needed exposure immediately, and price was secondary. That is the opposite of speculative behavior. Speculators chase trends when liquidity is abundant and risk is manageable. They scale in slowly. They wait for confirmation. They don't slam the market during thin sessions. What we saw at 106.55 was forced urgency, not casual positioning. This is why calling it volatility misses the point. Volatility is noise. This was a signal that available sellers at lower prices simply weren't there. Think about that for a moment. At already elevated levels, in an off-hours market, there were not enough willing sellers to absorb the buying pressure. That means existing holders were either unwilling or unable to part with supply at prevailing prices. And that's where stress begins. Because in a healthy, well-balanced market, supply shows up quickly when price rises. Sellers step in, price stabilizes, moves are absorbed. But when price jumps because supply doesn't respond, that tells you the system is tighter than it looks on the surface. This is especially important in silver because the market most people watch, the futures market, is not the physical market. Futures contracts represent paper claims, not metal in hand. Most are never settled with delivery, they're rolled, offset, or cash settled. For decades, this system worked because physical supply was assumed to be abundant enough that delivery risk was theoretical. But when you start seeing violent repricing in futures during thin hours, it suggests that assumption is being questioned. The market is no longer behaving as if supply is guaranteed. And that's why this move matters more than any slow grind higher during regular hours. Slow rallies can be explained away. They can be managed. They can be faded. Sudden gaps cannot. They force participants to reprice risk immediately. They expose where the market is fragile. They reveal where price is being artificially stabilized during normal hours, and what happens when that stabilization temporarily disappears. That's what happened here. The 106.55 print wasn't a random spike. It was the market briefly showing you what price looks like without comfort, without cushioning, and without confidence in available supply. And once a market shows you that, you can't unsee it, even if price retraces, even if the move gets sold down. The information has already been revealed, because markets don't spike violently in off hours unless something underneath is forcing them to. It could be a large buyer, it could be a delivery concern, it could be hedging against geopolitical risk, it could be multiple pressures converging at once, but whatever the catalyst, the message is the same. The market is tighter than it's been priced for, and that's why this wasn't just another green candle. It was a warning flare, a reminder that price stability is often an illusion, one that only holds as long as participants believe supply will always be there when needed. Tonight, for a brief moment, the market behaved as if it wasn't so sure. And that uncertainty is exactly what turns normal volatility into something far more dangerous and far more important to pay attention to. Venezuela-driven geopolitical risk is fueling safe haven flows. Once you understand that the 106.55 silver spike was a stress signal, the next question becomes obvious. What stress is the market responding to? Because markets don't reprice violently without a catalyst. And in this case, that catalyst isn't a single earnings report, a data release, or a technical breakout. It's geopolitical risk. specifically risk tied to Venezuela, spilling into global capital markets. For years, Venezuela has been treated as background noise by investors. Sanctions, political instability, currency collapse, all of it was considered priced in, something that affected regional oil markets but stayed largely contained. That perception is changing, and when perception changes, capital moves fast. Geopolitical risk doesn't announce itself neatly. It shows up indirectly, through sudden demand for assets that do not depend on political promises, supply chains, or counterparty trust. That's why silver matters here. Silver sits at a rare intersection. It is both an industrial input and a monetary metal. It participates in economic growth and in economic fear. So when geopolitical tension rises, silver doesn't just rise because factories need more of it. It rises because investors, institutions, and sovereign actors start asking a different question. What holds value if the system becomes unstable? That question is now being asked more loudly. Venezuela's instability has become a pressure point because it highlights something broader, the fragility of political order in resource-rich nations and the ripple effects that fragility creates. When a country with significant natural resources is locked in conflict, sanctions, or internal chaos, global markets don't just worry about that country. They worry about precedent. They worry about escalation. They worry about retaliation. They worry about supply disruptions spreading, and once those worries surface, capital doesn't wait for confirmation. It moves preemptively. That's what safe haven flows are. They are not predictions. They are insurance purchases. Silver's violent move suggests that this insurance buying is no longer gradual. It's becoming urgent. Here's why that matters for the U.S. economy. When capital flows into safe havens, it flows out of risk. That doesn't always show up immediately in stock indices, but it shows up in volatility, bond market stress, and currency positioning. A surge into silver signals that confidence in stability, political, economic, or monetary, is being questioned at the margin. Not collapsing, not panicking, but questioned. And markets don't need panic to reprice. They only need doubt. Venezuela's situation feeds that doubt because it reinforces a pattern investors are increasingly uncomfortable with. Resource nationalism, sanctions as economic weapons, asset seizures, export restrictions, political instability in commodity-rich regions. These are not isolated events anymore. They are becoming structural features of the global system, and when investors start viewing them that way, they seek assets that are outside the control of any single government. Silver fits that role. It's globally recognized, it's physically finite, it's historically monetary, and it's essential to modern industry. That combination makes it extremely sensitive to geopolitical shifts, which is why silver reacts before the broader economy does. Think of silver as a stress sensor, not a headline asset. It doesn't wait for economists to revise forecasts. It doesn't wait for central banks to issue statements. It moves when risk managers quietly rebalance portfolios behind the scenes. And that's what makes the 106.55 spike so important. It suggests that geopolitical uncertainty tied to Venezuela isn't being dismissed anymore. It's being hedged against. Now, does this mean Venezuela alone caused the move? No, markets rarely move for a single reason. But Venezuela represents a trigger point, a reminder that geopolitical stability is deteriorating in places that matter to global resource flows. And once that reminder hits, investors don't compartmentalize risk neatly. They generalize it. They ask, if instability can escalate here, where else could it spread? What assets are most exposed? What assets sit outside that risk? Silver benefits directly from that line of thinking. And when enough institutions ask those questions at the same time, you don't get a smooth rally, you get a gap, you get urgency. You get price discovery happening where liquidity is weakest, exactly like what we saw. This is why the silver move matters beyond the metal itself. It reflects a subtle but critical shift in how risk is being priced globally, and how quickly capital is willing to move when political instability threatens the assumptions markets rely on. Silver didn't spike because traders were excited. It spiked because confidence blinked, and once confidence starts blinking, safe haven flows don't reverse easily. They pause, they consolidate, but they tend to come back stronger until the underlying uncertainty is resolved, and right now, that uncertainty is not being resolved. It's spreading. Silver's explosion reflects broader U.S. economic vulnerability. Once you understand that silver's spike to 106.55 was a stress signal, and once you recognize that geopolitical risk, including Venezuela, is pushing capital into safe havens, the next layer becomes unavoidable. This move is not just about silver, it's about the underlying health of the U.S. economic system, because silver does not exist in isolation. It is woven directly into the structure of modern economies, especially the U.S. economy. When silver spikes violently, it's not just traders reacting. It's risk being repriced across the system. Silver sits at a unique intersection. It is both a financial hedge and a critical industrial input. That makes it extremely sensitive to stress. Gold can rally purely on fear. Silver rallies when fear collides with real-world demand. And that collision is what should concern policymakers, businesses, and consumers alike. From an economic standpoint, silver is embedded everywhere: energy infrastructure, electronics, defense systems, medical equipment, data centers, and advanced manufacturing. So when silver's price jumps abruptly, it signals that input costs are under threat. That matters because the U.S. economy is already struggling with sticky inflation, rising debt servicing costs, and slowing growth. A sharp repricing in a strategic commodity adds pressure to an already fragile system, and this is where the U.S. vulnerability becomes clear. For decades, the U.S. economy benefited from globalization, stable trade routes, cheap energy, and abundant materials. That allowed inflation to remain subdued while asset prices inflated quietly in the background. That era is ending. What silver's move is telling you is that cost stability is no longer guaranteed. When safe haven demand drives silver higher, it feeds directly into inflation expectations, even if official data lags behind. Markets price the future, not the past. A sudden silver spike suggests investors are beginning to price in higher production costs, supply chain disruptions, geopolitical risk premiums, and reduced confidence in long-term monetary stability. And when those expectations rise, they don't stay confined to metals. They ripple outward. Bond yields react. Currency positioning shifts. Equity valuations become more fragile. This is how a commodity move becomes a macro signal. Now layer in the U.S. fiscal reality. The United States is running historic deficits during a period of nominal economic strength, something that should make investors uncomfortable. Debt servicing costs are rising, interest payments are crowding out productive spending, and political consensus on fiscal discipline is non-existent. In that environment, the U.S. dollar relies heavily on confidence. Confidence that inflation will be contained, that growth will persist, and that geopolitical dominance will remain intact. Silver doesn't care about narratives. When silver spikes violently, it suggests that some participants are quietly hedging against the erosion of that confidence, not abandoning the dollar, not predicting collapse, but reducing exposure to assumptions that have held for decades. That's what makes this moment dangerous and important, because the U.S. economy doesn't crack all at once. It weakens gradually, then suddenly. Silver tends to move in that transition phase. It moves when cracks are forming, but before they are obvious. Think back to previous periods of economic stress. Silver surged ahead of inflation shocks, ahead of currency devaluations, ahead of financial crises, not because it predicted exact outcomes, but because it reflected rising uncertainty and declining trust in stability. That's what we're seeing again. And the reason it matters now is because the U.S. economy is less resilient than it appears on the surface. Households are stretched, corporate debt levels are high, government balance sheets are deteriorating. In that environment, volatility doesn't stay contained. When a strategic metal like silver reprices violently, it increases pressure everywhere else. It tightens financial conditions. It complicates monetary policy. It raises costs for industries the U.S. is actively trying to rebuild domestically. That's the irony. The U.S. is reshoring manufacturing, expanding defense production, and accelerating energy infrastructure, all of which require silver. So a silver spike isn't just a hedge signal, it's a cost warning. It tells you that rebuilding industrial capacity in a fragmented world is more expensive than policymakers admit. And when costs rise faster than productivity, something has to give. Either margins compress, or prices rise, or growth slows. None of those outcomes are benign. That's why this move matters beyond charts and tickers. It's a message that the U.S. economy is entering a phase where external shocks travel faster, costs adjust harder, and confidence becomes more fragile. Silver didn't explode because traders were optimistic. It exploded because the system is becoming less forgiving. And markets always sense that before governments acknowledge it. This is not a forecast of collapse, it's a warning of vulnerability. And warnings are only useful if they're heard before they turn into consequences.